Silver crossed $79 this morning. That's a 12-year high. Gold simultaneously pushed through 2,915. Both metals surged in the same hour. The COMEX reported allocation delays for the first time since 2020. Physical premiums spiked 18% overnight. Dealers in 3 countries halted online orders. This isn't profit-taking. This isn't technical breakout. This is panic allocation, the kind that happens when counterparty trust evaporates, when institutions question whether contracts will settle, when the paper market shows cracks. This is not normal price discovery. Let me walk you through exactly what happened, because the sequence matters. At 6:47 a.m. Eastern, silver futures gapped up $2.40 at the London Open. No news catalyst, no headline, just violent buying pressure that overwhelmed the order book. By 7:15 a.m., we saw the first liquidity fracture. Bid-ask spreads on the SLV ETF widened to 14 cents. That's massive. Normal spread is 2 cents. Then gold joined. At 8:02 a.m., spot gold jumped $38 in 4 minutes. 4 minutes. High-frequency algorithms pulled liquidity. Market makers stepped back. This created a feedback loop. Less liquidity means bigger moves. Bigger moves scare more liquidity away. But here's where it gets critical. I'm watching the COMEX opening, and something unusual appears in the March delivery data. Open interest dropped 4,200 contracts overnight, but registered silver inventory, the metal actually available for delivery, only increased by 1.1 million ounces. That math doesn't work. Those contracts represent 21 million ounces. Where's the other 20 million? It stayed in the futures market. It rolled forward. It became someone else's problem next month. Now look at the physical side. By 9:30 a.m., I'm checking dealer websites. SD Bullion. Expect 7 10-day delays. APMEX. Silver Eagle premiums jumped from $4.50 to $6.25 over spot. JM Bullion suspended their buyback program. Suspended. They're not buying silver back from customers because they can't source enough to meet retail demand. Meanwhile, the U.S. Mint reported they've already sold 58% of their monthly Silver Eagle allocation, and we're only 6 days into January. This is the disconnect I keep talking about. Paper silver, the futures contracts, the ETF shares, the synthetic exposure, is trading like there's infinite supply. But physical silver, the actual metal, is behaving like a commodity in shortage. The spread between those two realities, that's where the crisis lives. So what's driving this? What changed? 3 geopolitical pressure points converged in 72 hours. First, Middle East escalation. Reports emerged Sunday night that Iranian proxy forces struck commercial shipping lanes near the Strait of Hormuz again. This isn't new, but the response is. The U.S. moved a carrier group into offensive positioning. Energy markets spiked. Brent crude jumped 4.7%. When energy becomes a weapon, hard assets become shelters. Second, Eastern European banking stress. A major Polish bank suspended withdrawals on Friday for technical maintenance. Technical maintenance doesn't happen on a Friday. It happens when liquidity is questionable. Polish zloty dropped 3% against the dollar. Their central bank held an emergency meeting over the weekend. No official statement released. That silence, that's what concerns me. Third, China made a move. The People's Bank of China bought another 12 tons of gold in December. That's 8 consecutive months of accumulation. But here's the detail that matters. They're now publicly encouraging citizens to increase precious metals holdings. State media ran 3 separate segments last week about financial resilience through tangible assets. When a government tells 1.4 billion people to buy gold and silver, and that government is actively de-dollarizing, and that government is in a trade conflict with the West, you don't ignore that signal. These 3 catalysts individually would create volatility. Together they create what we're seeing. A coordinated rush into monetary metals by institutions and sovereign entities who see currency risk, counterparty risk, and systemic fragility accelerating. This isn't speculation. This is observable behavior from actors with trillion-dollar balance sheets protecting themselves. Let's talk about the lie at the center of the precious metals market. The paper market operates on leverage. Estimates vary, but the consensus is that for every ounce of physical silver in COMEX vaults, there are between 100 and 250 claims on that ounce through futures contracts, ETF shares, and allocated accounts. This works perfectly fine when everyone plays along, when contract holders accept cash settlement, when investors trust the system will deliver. But what happens when they don't? I'm looking at COMEX registered silver right now. It's sitting at 42.6 million ounces. That sounds like a lot until you realize that's only $3.4 billion worth of metal, backing a market with open interest representing 920 million ounces. The ratio is 22 to 1, 22 claims on every real ounce. Now watch what happens when physical buyers step in. Last week, a European fund, name not disclosed but confirmed through exchange filings, took delivery of 5 million ounces from COMEX. One entity, 5 million ounces. That's 12% of the entire registered inventory. Gone. Vaulted in Zurich. Off the market. If 10 more funds do that, the COMEX is empty. And here's the terrifying part. They can't stop it. Futures contracts are legally binding delivery instruments. If you hold a contract to expiration and demand delivery, they must provide it or declare force majeure, a nice word for default. We've already seen fractures. In March 2020, gold futures dislocated from spot by $70. The spread got so extreme that the CME had to fly physical gold from London to New York on charter planes to prevent a delivery crisis. They don't advertise that, but it happened. Silver's smaller market makes it more vulnerable. Industrial demand consumes 50% of annual production. Investment demand is surging. Mine supply is flat. And now geopolitical buyers are entering with size. The math doesn't work. The paper market is writing checks the physical market can't cash. And $79 silver? That might just be the market starting to figure that out. This pattern has a history. In 1979, silver went from $6 to $40 in 12 months. The catalyst? Geopolitical chaos, Iran hostage crisis, Soviet invasion of Afghanistan, dollar crisis, inflation at 13%. The Hunt brothers tried to corner the market because they saw the same fractional reserve structure that exists today. The establishment crushed them. Changed margin requirements, changed delivery rules mid-game. Silver crashed. But here's what they don't tell you. Physical silver remained scarce for 3 years after the price collapsed. Premium stayed elevated. Delivery delays persisted. In 2011, silver hit $49 again. European debt crisis, Fukushima, QE2, Middle East revolutions, the same geopolitical cocktail. CME raised margin requirements 5 times in 9 days. Silver dropped 30% in a week. But again, physical availability stayed tight for 18 months. In 2020, we saw it again briefly. Pandemic panic. Mints shut down. Premiums hit $8 over spot. You couldn't find silver anywhere, yet the paper price was $14. The disconnect lasted 9 months. Now it's 2026. We're at $79. And I'm seeing the same early warning signs. The difference this time? Central banks are buyers, not sellers. In the 80s and 2011, central banks leased gold and silver to suppress prices. They were willing sellers. Today, they're net accumulators. That changes everything. When the entities that used to provide the release valve become competitors for physical metal, the pressure has nowhere to go except price. And if price goes high enough, the paper market breaks. We might be watching that break happen in real time. Let me show you what institutions are doing when they think you're not watching. JP Morgan's commodity desk increased silver inventory by 23% in Q4. That's not speculation. That's disclosed in their warehouse receipts. They're not doing that for yield. They're doing it for strategic positioning. A Scandinavian sovereign wealth fund, one of the largest in the world, allocated 4% of their portfolio to physical precious metals last quarter. 4% doesn't sound like much until you realize that's $37 billion. They don't allocate $37 billion on a hunch. Hedge funds are moving too. Crescat Capital, known for macro crisis positioning, went from 18% metals exposure to 31% in 3 months. Sprott Asset Management launched their third physical silver fund in 16 months. Why? Because demand for the first 2 exceeded their wildest projections. Then there's the quiet moves. Private wealth clients, the ultra-high net worth individuals, are buying physical in size and vaulting internationally. Singapore vaults reported record inflows. Swiss vaults are quoting 6 to 8 week delays for new accounts. This isn't retail FOMO. This is institutional wealth preservation. When billionaires and sovereign funds move in unison toward tangible assets, they're seeing risks the headlines aren't reporting yet. They're pricing in scenarios where counterparty trust, currency stability, and financial system integrity become questionable. They're not trying to make money. They're trying not to lose it. So what does this mean going forward? If this is a short-term geopolitical spike, we'll see profit-taking premiums normalize and dealer inventories stabilize within 2 to 3 weeks. That's the optimistic scenario. Possible, but increasingly unlikely given the institutional behavior we just covered. If this is a structural shift, a genuine crisis in confidence, then we're in the early innings. Silver could test $90-$100 as physical shortage forces paper market reconciliation. Premiums could hit $10-$12 over spot. Delivery delays could extend to months, not weeks. Governments might intervene with export restrictions or allocation controls like we saw with other commodities. There's a third scenario nobody wants to discuss: market failure. If enough entities stand for delivery simultaneously, the COMEX might invoke force majeure. Cash settlement becomes mandatory. At that point, paper silver and physical silver become 2 different assets with 2 different prices. The premium becomes permanent. That's not speculation. It's happened in other commodity markets. Palladium in 2000. Nickel in 2022 on the LME. Watch for these signals. Registered COMEX inventory below 30 million ounces, critical threshold. Premiums above $8 sustained for more than 10 days. Physical shortage confirmed. ETF redemption halts or suspensions, structural fracture. Government statements about precious metals markets, intervention imminent. We're not there yet, but we're closer than we've been in years. The system depends on everyone believing the paper, and physical are equivalent. The moment that belief cracks, price discovery becomes violent. Here's where we are. Silver hit $79 on a cocktail of geopolitical panic, physical shortage signals, and institutional accumulation. This isn't technical, this isn't charts. This is the market smelling smoke and moving before the fire alarm sounds. The paper market is still trading like everything's fine. Physical dealers are acting like everything's not. That gap, that cognitive dissonance between synthetic exposure and tangible metal, is where crises reveal themselves. I don't know if silver hits $100 or crashes back to $60 next month. Nobody does. But I know the mechanics at play here. I know the historical precedents. I know what institutional behavior looks like when sophisticated money is protecting capital, not seeking returns. And I know that when governments, billionaires, and central banks all start moving toward the same asset class simultaneously, dismissing it as speculation is dangerous. This is not financial advice. This is not a recommendation. This is observable reality. The precious metals market is under stress. The question isn't whether that's true. The question is what comes next when stress becomes fracture. Stay vigilant.